How you guys all doing today? Good, I hope. Can you hear me?
Yeah.
Okay, good. I've been having some internet problems this morning, so it shut off a couple times during my psychology class, and then I came back on and they couldn't even hear me. So I just want to make sure everything's working right now before we get started. Okay, so yesterday we had ended up talking about how to finance cars and houses, and we were getting into the credit for housing and what you need to consider in terms of housing. And I'm going to kind of continue that discussion today in that regards. So, how do you rent or buy a place to live? And while most of you are probably going to be focused on the rental market coming up as you go to college, a few might be ready to purchase a home. And so, we're going to take a look at considerations for both here. So, let's start with renting. Renting property rather than owning is an option for people who are not yet ready to settle down, who will be living in an area only temporarily, such as you're going to college in, let's say, West Lafayette at Purdue, and you don't plan on living the rest of your life in West Lafayette, so renting would probably be a good idea for you. Those who are not willing to meet the financial obligations of a mortgage, because just because you buy a house doesn't mean the financial obligations stop. When you rent, the landlord's responsible for property taxes, upkeep of the property, maintenance, things like that. But when you buy the home, all that stuff is now on you. And so there's lots of costs associated with owning a home that you don't have when you're actually renting. So you get to, if you don't want the hassles of a mortgage and property taxes and keeping the home up and repaired, then you might choose to enjoy the benefits and flexibility of renting. College and graduate students, they often rent just so they can get out of the dorms. The dorms are noisy, there's lots of distractions, usually not a good place to study. You don't have a lot of freedom with your roommate. And so moving out is kind of an option for a lot of college students. Renting might offer students more privacy, a more productive atmosphere for studying, and the ability to cook their own meals rather than use the school's cafeteria. And I'll tell you a funny story about that. My wife went to Eastern in Charleston, and I went to visit her at the dorms. And I'm walking back behind her dorm. Her dorm had the dining hall or the dining room for like two different residence halls. And they're unloading a truck, and I kid you not, they were unloading a box, and on the side of that box it said beef, grade D, but still edible. So a lot of people just want to eat real food instead of dog food, basically, is what I saw them unloading off that van. And so they'll choose that. So renting may also enable students to bring cars to school because parking is an issue on a lot of university campuses. And a lot of times they won't even allow freshmen to bring vehicles to campus. And as well as sporting equipment such as bikes or kayaks. There's nowhere to store a lot of this stuff in your dorm room. There's lots of limited space. Now, if you are interested in budget, your rental budget is going to guide your search. If you want to rent a really nice apartment that's right across the street from the university and where you'll take all your classes, be prepared to pay a lot more in rent. Now, if you want just a small place that, might not be the best, but it's not flea ridden, but it's not super modern and it's a few miles away from campus, you will pay less for it. So you may find that rental rates are prohibitively high in your first choice area. So it's a good idea to have several areas in mind. Other factors to include when you rent also are the amenities. Amenities are extras besides just a place to live. Today's apartment complexes, particularly ones near university campuses, offer an array of amenities. Some of them have 24-hour fitness centers for the residents, 24-hour concierge services, in other words, people to run your errands. In general, the more high-end the amenities, the higher the monthly rent is likely to be to cover those. Most rental communities, such as apartment complexes or townhome rental communities, have websites that describe the amenities, as these are often selling points for renters. One of the most common amenities, two of the most common amenities, one, that appliances are included, so you don't have to go out and buy a refrigerator. They might have a laundry room that the residents can share and use. You might have to pay for each load with quarters, but they have washers and dryers, so you don't have to purchase one, put it in your apartment. And the second most common one, the pool. There's usually some sort of communal pool. So these may be divided into interior amenities, like the appliances that refer to each of the individual rental units, and community amenities like the laundry room and the pool that describe the property-wide features open to all residents. You also want to consider your commute. If you go to Eastern, Charleston's not that bad a commute. You can pretty much bike from anywhere in town and be on campus in 15 minutes or even walk. You go to the University of Chicago, lot different story. Traffic there is pretty bad. And if you live across town, it might take you 3 hours to get to work. So paying a little bit more money in rent might be worth it to live closer to campus. So you should consider what your daily commute to work and or school will be. It might make financial sense to rent closer to work or school, even if it demands a higher monthly rental rate because of the gas money and time that you'll save, particularly in urban areas with known rush hour traffic problems. If you love your pets and you want to have pets, certain rentals will allow you to have a pet. Usually you have to pay a little bit extra, like a pet deposit that will be returned if there's no pet damage, but don't count on that. You might take care of the apartment perfectly, no pet damage, and they'll find some little nick or something to keep your deposit. That's landlords. They'll try to do that. Or they might charge you a non-refundable pet fee, or tack that onto the top of your rent to increase your rent some. So the fee is often used to deflea, deodorize, and shampoo the unit's flooring in or upholstery, or just to a little extra to pad their pockets. You may also have to pay, like I said, pet rent, a monthly or yearly fee intended to cover expenses related to normal wear and tear from the animals. Some properties have breed-specific restrictions. So if if you're a lovable little pit bull, unfortunately they have a bad reputation. I love pit bulls. If you know Mrs. Butts, she's got a big old bulky pit bull. I was playing with him yesterday on the side of the road. So, but a lot of these, because of their bad reputation and the cost of insurance goes up if they allow them, will not allow certain breeds like that. And even if you list it as a support animal, it can become very iffy. I know a woman who has a support pony. I don't know her personally, but I know of a woman around here who has a support pony. I doubt she's going to find a landlord who's going to rent to her, even though the pony is a support animal. So landlords may also limit the number of animals allowed in any one unit and enforce weight and height limitations, hence why I doubt the pony will be acceptable. Now, one big thing you'll want to consider in order to defray costs for you is roommates or multiple roommates, where you can divide the cost between you. Now, here's the thing. You're sitting here thinking, oh, man, my best buddy. We've lived across the street from each other our whole lives. He's always over here. I'm always over at his place. It's like we live together. So why not live together when we go to college? Let's be roommates. Sometimes that doesn't work out. But if you decide for financial or social reasons to find a roommate, you have to be careful that you have similar housing goals. When you're kids and you're spending all that time at each other's houses, it's not the same. Your parents will take care of everything for you when you're kids. If your buddy leaves a mess, it's okay. He's a guest. We'll clean up. But when you're living together, you're not guests anymore, and there's certain expectations. And I've seen a lot of friendships ruined for life because one guy's a loud partier and leaves half-empty bowls of cereal around, doesn't clean up his clothes, just throws them on the floor, and the other person is like, God, I got to study. We need to keep it down. I want to clean up. I want the place to be somewhat neat. I want my bills paid on time. The other guy's kind of loose on that. And so these kind of things, when you're actually living together and you're not just guests at each other's house, cause a lot of friction. So you have to be very careful with this. So some things to consider here about similar housing goals. Are you interested in a quiet home life, loud music and parties, or something in between? Regardless of the lifestyle, it's important that all roommates share common goals. Otherwise, the living situation can quickly turn bad. And you can find roommates by word of mouth if you don't have a buddy, campus newspapers, or by searching a variety of online roommate matching services online. They're kind of like dating services. Matter of fact, a lot of universities have that ability on the university website to do that. So a quick Google search for rental roommate is going to bring up a number of these websites. It might be easier to find a compatible roommate if you ask questions of the other one. And this includes your best friend, just to make sure it's not going to cause friction, that you're both on the same page about things. When should stereos be turned off and parties kind of die down? How will cooking and food shopping be shared? You make yourself this nice meal with a little bit of money you have because you're a poor college student, and you're thinking, man, this will last me 3 days. And so you're at school all day, and your stomach's rumbling. You're ready to come home and dig into that. And you get home and find out your roommates ate the whole thing. Is that going to be fair? What's their expectation there? Who should do food shopping? That's one thing a lot of people forget when they think, oh, I'll just cook for myself. Well, shopping takes time. and money as well. But the time a lot of people forget about, and who's going to be responsible for going out and doing those things? Who will write the checks for rent and utilities? I mean, if you have 4 roommates and you're splitting it 5 ways, then who's going to be responsible for collecting all 5 payments, putting them on one check and sending it in? Is that person responsible? What if someone doesn't pay their share, but everybody else did? How are you going to handle these things? Is it okay for girlfriends or boyfriends to spend the night? And if so, how often? Again, if they're living there, but they're not paying their share, it can be kind of frustrating for you who's paying for stuff. And, you can never get anything done because their girlfriend's watching TV or their boyfriend's using the shower. It can be kind of frustrating after a while. How will rent be divided? Is it 50-50, or is one person in charge of the utilities, the other person's in charge of the rent? Who will get which bedroom? And that can turn into a big fight. Listen, you have a bedroom whose window faces east. Do you want to wake up at 5 every morning because the sun's glaring right in your window? Maybe the other guy doesn't either. Which one's bigger? So determining exit procedures if things don't work out or there's a change in life is also helpful. How much notice will roommates give one another before moving out? If you don't give 30 days notice, are you still responsible for the next month's rent or your share of it? For how long will they continue to pay rent once they've moved out? Is this a semester-long deal where they're moving out in June, but the lease goes to August, and so they're responsible for July and August rent as well? Will the roommate be responsible for finding a replacement? If the only reason you guys got this apartment is because you had divided it 5 ways with the rent, and that's how you're affording it, if one person moves out, then should they be responsible for finding someone to keep it up so everybody else can still live there? And addressing these questions ahead of time, discussing them, maybe even, and I hate to say this because it sounds like Sheldon on the Big Bang Theory, maybe even working out a little contract between each other can help create a better experience for everyone. It doesn't have to be as detailed as Sheldon's roommate contract, but for added peace of mind, you can enter into a roommate agreement that defines the terms of the co-tenancy and outlines details such as each person's share of the rent and utilities, who gets which bedroom, how will chores be divided, how food and shopping will be handled, rules regarding guests, and plans for dispute resolution. All things you can certainly consider in that. So that's what you should consider in renting. Now let's talk about buying a home and what you need to consider in there. Buying a home is usually the single largest investment that a person will make in their life. There's not too often that, a basic home is probably going to run about, and we're talking about a 2-bedroom, half-acre yard, probably going to run you in this market anyway, in around this area, about $150,000 minimum. There's not too many times in life that you're going to drop $150,000 on something. So the house is a huge thing. The first thing you have to remember about owning a home is it is an investment. It's not something you buy, like a stereo and you just wear it down, and once it's wear down, you buy another one. No, you're hoping to keep it up and everything so that when you sell it, you get it back, plus maybe an increase in the property value because of inflation or amenities you've added to it. So this is why people get really upset if you move, you bought a house in a nice neighborhood, you love the elderly couple who lives next door, but then they move out. And the guys who move in decided to turn their yard into a junkyard. What does that do to your property value now? That's going to decrease it. You're losing money on your investment. And this is why people get very upset about things their neighbors are doing in a lot of cases. So for most buyers of a home, the process is lengthy and emotionally and financially demanding. And although there are many factors to consider and steps to take before buying a house, we're going to focus only on a key financial aspect today, and that is getting a mortgage. Most home buyers will need to secure a mortgage to finance their home. Most people don't have 150 grand or more in their pocket. Oh, that's a nice house. There you go. A lot of teens and young adults, they'll be unable to qualify for financing on their own, often because of a lack of credit history, which we discussed yesterday in terms of the FICO score. And remember, even responsible young adults are at a disadvantage in terms of credit scores simply because they have an inherently short credit history. So as an adult, your parents can co-sign on a mortgage, but that option needs to be carefully considered since the amount of the loan will be considered both your parents' debt and yours. So if something happens to you and you forego on it, your parents are now responsible. They might be paying 2 mortgages, thinking that you would be responsible enough, secure enough to be able to do this. And so if you back down, your parents are now at risk of their credit. So how do you get a mortgage? All a mortgage is a pledge of real property as security for the payment of money. So you borrow the money for a house, your house is the collateral. In other words, if you don't pay on the mortgage, they repossess the home, basically, or what they call foreclosure. They'll foreclose on the property. So, and you have a variety of options in terms of lenders and loan types, though, to get this mortgage. Obtaining a mortgage can be a very daunting task. There's lots of steps that go into it. It can be very frustrating. If you know anybody who's ever bought a home and you've seen them pulling their hair out, that's because there's lots of things that go into it. You have to give the bank all kinds of information, and inevitably you give them all this information that it took you a week to put together, and they'll call, oh, we also need this. And then you have to hunt around and get this. It's always something when you're buying a home until you get to the final closing, which could take anywhere from 2 to 6 months to do. There's all kinds of inspections that have to be done to make sure the bank isn't just loaning you a ton of money for a worthless piece of property. So, but understanding your options and the process can help you find the best mortgage for your situation. So how do you choose a mortgage lender? Again, like I said yesterday, just because you bank somewhere doesn't mean you're tied to that bank for things. Shop around, look at different options for different interest rates, and see what works best for you. If your bank's First Financial, there's nothing that says you can't go and get a mortgage loan at the Preferred Bank over by Walmart. So a variety of banks, mortgage brokers, and online vendors provide mortgages to home buyers. Banks are the traditional source of mortgage funding. They offer in-person meetings with someone to help walk you through, particularly if it's your first time home purchase. They have a recognized name brand. They have competitive fees. However, they usually don't offer a broad variety of products for you, and as a result, may not offer the lowest interest rates or the lowest fees. And so you might pay a little bit more for that comfort of having an expert being able to sit down and talk with you. Now, if you feel somewhat comfortable with it, there is a group of people known as mortgage brokers, and they kind of act as middle people between lenders and borrowers. And typically they offer a variety of loans, including loans for people who have bad credit. Brokers might offer in-person services and be able to provide loans with lower interest rates. However, their fees are usually more expensive than a bank or an online funding. And so, they're kind of the middle ground. Now, lastly, if you feel super comfortable and you don't need a lot of hand holding, online mortgage providers, like if you've ever heard of Rocket Mortgage, they have commercials I hear on the radio every now and then. They offer a large variety of loan types, convenient 24-hour shopping. You can sit down in your underwear at 2 a.m. and flip through the computer and look at loan options, and instant comparison between the multiple loans as well. However, if you have questions or you run into a snafu or a snag, then in-person services are not available, and it might be hard to get to talk to someone live in order to work through some issues. So that can leave you with some unanswered questions. And so you're saving money, but that's because you're on your own. Personal and financial factors are probably going to affect the decision to go with a bank, a mortgage broker, or an online mortgage provider. But if you want to discuss the mortgage face-to-face with the lender, you should probably shop at banks or mortgage brokers instead of online. If you feel somewhat comfortable with it, that this isn't your first rodeo, as the old saying goes, then maybe a mortgage broker is better. But if you need a lot of hand-holding and walking through real estate laws and things, I definitely would go to the bank, even though you're going to pay a little bit more for that service. So this may be the best idea for teens, especially if you have a co-signer, because you can be more involved in the process and ask questions directly. And if you're web savvy, however, and familiar enough with the process to teach yourself, then you might benefit with the cost savings of using an online mortgage provider. So a lender can help determine the amount of money that can be borrowed through a process called pre-qualification. Now, this is different than pre-approval. Pre-qualification, typically you meet with a lender, you provide information regarding your assets, your liabilities, your income, and the lender will provide an estimate of the size of the potential loan they can give you. Now, this is just an estimate going, okay, everything else, being good, then here's how much we think we could probably loan you. It's not a guarantee they will loan you that amount. It's just, okay, here's our best estimate about what we can loan you. So pre-qualification kind of helps you determine your appropriate price range as you go out and shop for homes. You need to apply for the mortgage by completing the necessary paperwork. And after a lender verifies everything you give them as proof, such as your income through bank statements, payroll check, copies of that. Your credit score, your employment information, calculating your debt to income ratio. The lender can then pre-approve you for a certain amount. Now, if you're pre-approved, that means that we are going to loan you this much if you want it. It's a guarantee at that point. So if you're out shopping for a home and you come across, your dream home, this is the one you want, it's within your budget, but there's another couple there who's saying, we want it too. What would be better for you as a bidder, to be pre-qualified or to be pre-approved? And anybody can answer that. Anybody? Anybody? Bueller?
Pre-approved.
Pre-approved, yes. Be much better to be pre-approved because you're guaranteed by the bank to have that money already. If you're pre-qualified, it's not a guarantee, it's just an estimate. So pre-approved means you would actually have this. Now, if you have a co-signer on your mortgage, they need to provide all this information as well to get that pre-approval. And what this confirms is your eligibility to qualify for a mortgage, which, as I asked, would definitely strengthen your position when finding a desired property and making an offer. So depending on the type of property involved and the particular mortgage, you will probably have to make a down payment. The down payment is your security. Now, there are some mortgages out there that do not require a down payment, but usually they'll be at a higher interest rate because there's more risk involved. If you're making a down payment on the property, that means you have some stake in the property, that you've put in some what we call sweat equity. In other words, you've worked for the money and you have some ownership in it. And if you have some ownership in it, you're less likely to just tear the place apart and run away. And so they want you to have some kind of down payment. And down payments can range from about 3.5% to 20% or higher, depending on your credit score. Lenders may require up to a 50% down payment on certain types of properties as well, such as condominiums that are not on the FHA approved condominium list, for example. The closing on the property or settlement is the event that finally transfers ownership of property between the seller and the buyer. It's a done deal at that point. And the property will be recorded in your name or both of your names if you have a co-signer, and the city or county will be notified of the transaction and record the new owners of the property on the deed or title. So here's 10 things that first-time home buyers should know before they go through the whole closing and settlement and get everything done. And again, like I said, it's kind of a hassle. For one thing, the old owners are moving out. Did they leave a lot of trash behind? Well, you shouldn't have to pay for that. Maybe that comes off. And so you're not signing the closing until they've either had the trash removed or they've reduced the price. Or an inspection after you offered money on the property finds the foundation is cracked. And so to have that repaired, they might take money off the housing thing. Or, there's a variety of other things could happen along those lines, but you get the picture. So here's 10 things first-time home buyers should know. Number one, home prices go up and down. If you're looking at your home as an investment, and you very much should if you're buying it, don't be surprised you bought it for 150 grand, that next year it's only worth 148 grand because they, built a business, a factory near you, and no one wants to live near the noisy factory with all the lights. But then maybe that factory closes down, or all of a sudden the factory is real popular. It brings a lot more people in. Property values go up because there's lots of bidding competition on property values. Or maybe the factory wants to expand to where your house is and they're willing to pay for it. So these things go up and down pretty constantly. But just despite the likelihood that your prices will go up or down, and they'll appreciate usually at about the rate of inflation, which protects your investment over the long haul. If you paid $150,000 for it now, and in 20 years we've had 10% rate of inflation over those 20 years, well, your home should actually then be worth $165,000, $15,000 being that 10%, and you should be able to sell it at $165,000 at least, and therefore you've protected the value of your money against inflation. If you sold it for $150,000, 20 years from now, and with that 10% rate of inflation, you actually are selling it for about $135,000 in today's money. You've lost money, in other words, on your property. So just know its value will fluctuate over time, meaning it's likely that your home will, if only for a short time, be worth less than you pay for it and perhaps less than the mortgage on it. That's what we call being underwater. But don't freak out just because of a short-term thing. Any type of investment like a home ownership is a long-term investment, and you have to be able to ride out the curves and waves there. So be patient. Don't abandon your investment only because of a brief downturn in the market. Number two, real estate agents are paid by the seller. So there's no reason for you as a home buyer to not use a real estate agent. And generally in the United States, even when real estate agents sign agreements to represent buyers, the agents are paid by the sellers. And as a buyer, there's no reason not to work with an agent. Just be aware the agent is working on commission. So if you have a lower budget for a home, you might not get the best service from them and might have to take on some of the responsibility yourself. So they'll be eager to see you get into a home and may not be as picky about it as you are as well. Number three, mortgage rates below 5% are great. Currently, mortgage rates are just below 3.5%, which may be the lowest rate for mortgages in the history of the United States. But if you find yourself paying a rate of up to 5%, you should consider that a great rate. Any rate under 7% will generally allow home ownership. If it gets above 7%, you're probably paying more than double the price for the home and will never be able to recoup that money in the investment. It will just continue to lose. Number four, no prepayment penalties are allowed. So if you get a mortgage, let's say you've lived in the house for 10 years, your mortgage rate is 6.2%. Your credit's gotten better. You can go shop around and find another mortgage at, let's say, 3.2%, 3% off. That'll save you thousands of dollars on the price of the home over the 30-year mortgage. You can switch your mortgages. You can apply for this new mortgage at 3.2%, take the money they give you in that mortgage, pay off the old mortgage where you are at that point. And the other bank can't do anything about it. They can't say, oh, you're paying early, here's an extra fee or here's some extra interest. That is actually illegal. So no prepayment penalties like that are allowed. You can pay off your mortgage anytime, including when you refinance the mortgage to take advantage of lower rates. Now, what that means is if I'm paying that 6.2% annually on it, well, if I pay it off after 10 years and it's a 30-year mortgage, that's 20 years of mortgage payment, the interest payments that I don't have to make. So it's a huge savings to pay it off early. And if I can get a second mortgage and pay off the first one with that, then I can reduce my rates from 6.2 to 3.2%. And that saves me a whole ton of money over the course of that mortgage. So this means that fixed rate loans are in essence adjustable mortgages that can only go down if you use them. So you just have to reapply and qualify for the new mortgage at the lower rate. So I know a guy who he shops every year for new mortgage just because he keeps looking for lower and lower rates in order to, and he's probably saved about 30% of the cost of the house, from doing that. So next, down payments can be remarkably small. Traditionally, like I said, a home buyer needs a 20% down payment. Your grandparents, when they went to buy their first home, that was the expectation. You had 20% of the value of the home saved up to buy it. Now that changed about a generation ago with the advent of mortgage insurance that's usually sponsored by the federal government. Private insurers and the federal government, the FHA, Federal Homeowners Association, insure mortgages with smaller down payments. And that was because they wanted to encourage people who normally wouldn't be able to afford their own home to be able to save up and buy their own home by not having to save up as much for a down payment. And so a lot of people do that. There was even a point, I don't know if you've heard of Fannie Mae and Freddie Mac are federal mortgage insurance companies. They're sponsored by the federal government, and they had a lot of problems a few years ago in 2009 in particular when the housing market crashed because they had been loaning out no down payment loans to almost anybody because it was a political objective of the Clinton administration that poor people be able to afford a home. And what happened was a lot of people were just not paying their mortgages because they couldn't afford them. What they had gotten were adjustable rate mortgages, what we call ARM, adjustable rate mortgage. And these ARM mortgages, they changed the rates with the market. So people were buying it at very low interest rates. And then all of a sudden the adjustable rate went up, 4 or 5%. And people were like, my house is underwater. I mean, it's not even worth what the money I borrowed it for. I'm going to lose 50% of it. And so they would just say, bank, you keep the mortgage, I'm gone, I'm out of here. And they would just walk away. And so the whole housing market collapsed because of that, because before everybody was borrowing money. And then when the rates changed, they all figured out, oh man, I'm losing money. And they walked away, and banks were just stuck with these properties and the people didn't care because They didn't lose any money. They hardly pay any down payment, if any at all. So, you have to be very careful with these things. These programs allow you to buy a home with as little as 5% of the purchase price down, but it's still your home. And, the people who walked away from this, that did hurt their credit, and they're going to find it very hard to buy a home in the future if that's what they want to do. Next, the closing costs add up quickly. Every time the bank wants a piece of information, every time another inspection has to be done, that's going to cost you money. And these costs kind of tend to add up pretty quickly. The closing costs are largely associated with the cost of borrowing the money to buy the house, so the bank fees. And they'll usually total more than 2% of the purchase price of a home. So, $150,000 home, we're talking about $3,000 just in closing costs that are not part of the home costs. So in addition, you'll have to pay certain other costs at closing that aren't really closing costs, but kind of feel like they are. Such as at closing, you may have to pay prepaid interest and make a deposit to cover a portion of property taxes and homeowners insurance for next year. You might have to pay those a year ahead. Property taxes and homeowners insurance are going to be ongoing costs of homeowning due every year, even after your mortgage is fully paid off. And so I know in Clark County, we're looking at about 3% property taxes. That's $3,000 a year you have to pay on top of it. And so that's one of the things you have to consider between renting and owning. You don't pay property taxes when you're renting. The homeowner is paying that. And so if you want to continue to pay $3,000 a year, it's in a way it's kind of paying rent to the county just to own your own land. So these costs alone may eclipse any comparison cost you may have paid in rent alone. And these costs can easily total another 1% of the purchase price each year. Most lenders will allow the seller to pay these costs if you negotiate that up front in the contract and the appraisal matches the purchase price, though. So you may want to look into that. Next, qualifying for a mortgage is a challenge. First-time home buyers have a small advantage in the current market, and a lot of buyers today are among those who lost their homes in the Great Recession, as a result have tarnished credit, those people who walked away from their homes. So first-time home buyers should have perfect credit. And generally, without a foreclosure or bankruptcy on your credit report, you need 2 years of perfect credit, paying all your bills flawlessly on time to qualify for a market rate mortgage. And if you do not earn enough to qualify for the mortgage, you need to buy the home you want. A cosigner can help you to qualify. But if you have poor credit, a cosigner does not help. They don't look at the cosigner's credit to help you. So you want to get your parents because they have really good credit. That's not really going to help. The only thing that they'll look at with a cosigner is their income and their assets and wealth. But poor credit on your part doesn't matter if you have a cosigner. You can't borrow your down payment for obvious reasons. If you borrow your down payment, you have not put any of that sweat equity into it so that you feel like it's part of your home. So your lender is going to look carefully at your file for any evidence that you might have borrowed your down payment, including recent loans on your credit report. Matter of fact, if you even inquire as to your credit report score or a loan, they'll ding you on that and say, oh, he's looking for a loan. So don't trust him. So if any of your portion of your down payment is a gift, let's say your grandparents want to help you out, they give you $10,000. You will then be required to assert in writing that the financial help is a gift and not a loan. So if your grandparents do that for you, you're actually going to have a contract with them that asserts this is a gift, there's no expectation of payback, this is not a loan. Don't apply for credit before buying a home. If you're doing those things, they're going to look at it as you're looking for ways to get money without working for it because you can't really afford the home. And this is a kind of a backdoor way of getting that loan that we already talked about. So in the 6 months or so before you buy a home, do not buy anything else on credit. Reject store offers for new in-store credit accounts. Don't buy a car and finance it. Don't apply for any sort of credit. Just having someone pull your credit report goes on your credit report and is viewed negatively by underwriters who fear that you may either be borrowing your down payment or fear that you'll run up new debts and you can't afford after closing on the purchasing of your home. And with just this little bit of knowledge I've given you, you're kind of more prepared than ever to go out and purchase a new home if you keep these things in mind. Obviously, without us actually buying a home, I can't go into all the details, but this should give you a good way to start thinking about home ownership and what all is involved and whether or not that's something you really want to do. So do you guys have any questions for me today? Okay, well, it's a beautiful day today. Go out and enjoy it some. Just know that tomorrow we'll go over, this is the last presentation in this unit. So tomorrow we'll go over a budget and kind of look at how I would have, because I would have asked you to do this on the exam. And that at 4 o'clock today, we'll start on the first half of the back page of the 1040 tax return, doing taxes. And that on Canvas, there is a portion of the exam that I'll open up for you to do for extra credit on there. That would have been one half of the, actually there's 3 parts of this exam if we'd been in class. The first part was the Canvas portion, multiple choice, short answer. The second part was doing the budget. And the third part was your job interview. And next week, I'll be putting up times on there if you're interested in doing an online Zoom job interview for us to do that. So if you guys don't have any questions, then go have a great day.
You too, Mr. Klein.
Thank you.